Have you noticed how every time a major policy shift hits the news, one chart seems to move before anything else? It's not a poll or a political forecast. It's gold. Right now, gold is flirting with all-time highs. But what if I told you it could be heading for $4,000 an ounce? This isn't about politics. It's about math. Let's break down the chain reaction. Certain policies create friction in four key areas: tariffs, deficits, the dollar, and geopolitics. Each one builds pressure, and gold is the release valve. This isn't a left versus right thing, it's simple cause and effect. When uncertainty rises, inflation fears grow, or investors run for safety, gold gets a boost. And some economic playbooks hit all three buttons at once. Let's start with tariffs. Tariffs are just taxes on imports. They make foreign goods more expensive. Higher costs mean higher prices for you and me, which fuels inflation fears. When people expect prices to go up, they buy assets that hold their value. And gold is the original store of value. We saw this during recent trade conflicts. When tariff headlines hit, gold climbed from $1,700 to over $1,900 in just 2 years. The path wasn't straight, but the direction was clear. Now, imagine even broader tariffs. Inflation expectations would soar, and gold would likely follow. Next up, the deficit. Big spending plans, whether they're for tax cuts or new projects, cost a lot of money. When the government borrows more, it floods the market with treasury bonds. More supply can mean lower prices for those bonds, which leads to higher yields. Normally, higher yields strengthen the dollar. But here's the twist. If foreign buyers get nervous about the amount of debt, they might pull back. That weakens the dollar. A weaker dollar makes gold cheaper for buyers using other currencies. So demand rises, and so does the price. We've seen this play out before. When deficit concerns have weakened the dollar, gold has climbed. Then there's the Federal Reserve. Any hint of political pressure on the Fed to lower interest rates can have a huge impact. When markets suspect the Fed might not fight inflation aggressively, something called real yields can collapse. Real yields are just interest rates minus inflation, and they are gold's biggest enemy. Since gold doesn't pay interest, it becomes much more attractive when cash and bonds are losing purchasing power. History shows that when the Fed has pivoted to a more lenient stance under pressure, real yields fell, and gold surged by as much as 25%. It's a pattern that rhymes. Finally, we have geopolitical risk. Unpredictable foreign policy creates volatility. Think about trade threats, tensions with allies, or major deals being torn up. Markets hate uncertainty, and when things get rocky, investors flee to safety. Gold is the ultimate safe haven asset. During major geopolitical events, gold prices often spike. The more friction in the world, the higher the safety premium on gold. Let's zoom out. 3 times in modern history, policy pushed gold to new heights. First, in 1971, when the U.S. left the gold standard, gold skyrocketed from $35 to $850. Second, after the 2008 financial crisis, massive Fed stimulus sent gold from $700 to over $1,900. And third, the stimulus in 2020 pushed gold to its current all-time high. The common thread? Massive deficits, Fed accommodation, and currency risk. A similar combination could be on the horizon. But wait, it's not a one-way street. Gold could get crushed if the dollar strengthens, say, because the U.S. economy is outperforming everyone else. If real yields spike because inflation cools down but rates stay high, gold loses its appeal. And if global risks fade and optimism returns, that safe haven demand evaporates. The $4,000 call is a scenario, not a guarantee. It only happens if the dominoes fall in just the right order. Tariffs spark inflation, deficits weaken the dollar, and the Fed is forced to back down. So, how can you track this? Keep an eye on 5 things: tariff headlines, deficit projections, the dollar's strength, the DXY index, real yields, and global volatility. The more of these factors that light up, the stronger the case for gold becomes. So, could major policy shifts send gold to $4,000? Absolutely. But only if that chain reaction holds. It's not about who's in office. It's about the economic mechanism they set in motion. And right now, that mechanism is warming up. If this helped you understand the link between policy and gold, hit that like button. Let me know what you think about gold in the comments. And be sure to subscribe for more breakdowns like this. Thanks for watching, and I'll see you in the next one.